Since September of 2024, the Federal Reserve has cut interest rates 1.75 percentage points. But lowering interest rates could have some negative impacts in 2026. Bankrate senior industry analyst Ted Rossman joins me now with more. Hi, Ted.
Good to be here. Thank you.
So the Federal Reserve made a lot of interest rate cuts in 2025, but what usually follows is credit card rates. Can you talk about your forecast for that rate?
We have seen credit card rates come down a little bit in recent years, and I do believe they'll fall a bit further in 2026. Not enough to make a big difference, though. About a year and a half ago, the average credit card rate peaked at nearly 21%. Now it's down to 19.7. I think it'll go to the low 19s this year, but honestly, that's not saving people that much money. Only a few dollars a month on the minimum payment. So we're talking 19, 20, 21. These are all high. The advice there would be pay in full if you can. About half of cardholders do that every month. Or get a 0% balance transfer card, or work with a reputable nonprofit credit counselor like Money Management International. That's going to make more of a difference than the Fed cutting a quarter point here or quarter point there.
If someone's looking to buy a car this year, can they expect lower car loan rates?
A little bit. This is another one where it's not making a huge difference. Every quarter point probably trims a few dollars a month off the monthly payment. The issue with car affordability is that prices are high, insurance rates are high, repair costs are high. We don't see a ton of relief on that front. Rates are coming down a little bit. The area where I believe lower rates could help the most this year is mortgage rates. That's going to have more of an impact than autos or credit cards.
Now, the December jobs report also came out today. We saw a slightly lower unemployment rate at 4.5%. If we're seeing unemployment rates cool down, will this have an impact on interest rates to try and lower inflation rates to help displaced workers?
That's one of the big inputs. The Federal Reserve has this dual mandate from Congress. They're supposed to promote maximum employment and stable prices. And prices have actually been leveling off. I know they're too high for everybody's liking, but at least the growth rate has changed. And that's part of why we're seeing lower rates, because the Fed had to raise rates a lot in 22 and 23 to fight inflation, and then they've been kind of slowly dialing that back more towards normal. They've also been cutting rates to support a weakening job market. That gets into this sort of good news, bad news thing where it's good if rates come down because inflation's coming down. It's not so good if rates come down because the job market is weakening. So this is an area to watch this year. There's also a lot going on with the Fed chair's term ending in May and the president having the opportunity to appoint someone who he's really hoping will lower rates substantially. We just want rates to come down for the right reason, not political pressure, not a weaker job market. Really, it's all about hoping for a stable economy and lower inflation.
Finally, Ted, if someone's goal is to save in 2026, are high-yield savings accounts still going to help savers get rewarded, or should they maybe look into alternative ways to save money like a CD?
This is another silver lining. I mentioned that lower mortgage rates could be a big deal. I do think we could go below 6% this year for the first time in about 3.5 years. Savings rates remain attractive too. So the best yields are over 4% for savings and for 1- and 5-year CDs. Those are going to come down a little bit in 2026, but they'll probably still end the year somewhere in the upper 3s. And that means that we're beating inflation. This is really kind of sleep at night, safe kind of money. So to get 3.25 or 3 3/4 or 4% on your liquid money, that's actually pretty good. So not quite as good as we saw a year or two ago, but still pretty attractive relative to inflation. Not too late to sign up for a good savings account from an online bank or credit union or community bank. They tend to be the ones with the best rates, not the largest banks.
Ted, always great to talk to you. Thank you for your time. We appreciate it.
Of course. Thank you.